I wanted to provide a brief update on the gaming and professional services sectors stocks that are reporting in this coming reporting season. I've got a table up there which just outlines the stocks that are coming up this Feb with our ratings, targets, and so forth, and also consensus. You'll see that most of our recommendations and targets are pretty similar to those, with the exception of XIP, and I'll talk to that shortly. Our two key stocks that we would be happy buying heading into reporting season are both Jumbo and People Infrastructure, particularly on any weakness that you may see in stock prices today. So I'm just going to briefly go through these, and I'll be sending around some more information shortly. But IPH is the first one off the rank on the 15th. We do have an ad rating on this stock. It will be the first result for the new Managing Director, Andrew Blattman. We don't expect any surprises with it, given he's been with the company for a considerable amount of time. One thing that they have pre-flagged is that they will be collapsing their Australian brands and restructuring them under the Spruson and Ferguson label. This makes strategic sense to us, given that this is the brand that they operate in Asia, and with the existing Australian companies sending work up there, it makes it a lot cleaner from a client perspective. It will also result in annualized savings of about $1 to $2 million a year from FY19. So that certainly makes sense. One of the key issues for the stock is obviously the strength of the Aussie dollar, and it obviously has been moving around a fair bit at the moment. It averaged around 78 cents for the first half, which is in line with our expectations. We do forecast it to come off in the second half. However, there is risk to both potentially our numbers and consensus if the Aussie dollar does remain high on that front. The stock does generate very attractive and solid cash flows, and trading on about a 16 times based on the last price, FY19 PE. We certainly think it's one that people can add to, again, particularly on any weakness that we may see. Jumbo, as I said, they is one of our key picks. Just in early December, the company provided guidance, and then later in December upgraded that guidance because of a strong run of jackpots. There were 3 additional jackpots, which was looked to have driven the guided NPAT from about a top of 4.5 to 5 mil, which is certainly a clear illustration of what the jackpots can do to earnings for this business. The company recently added another charity lottery, and we see this as a key growth area for the group, and I think it'll be something that the market's keen to get a handle on, where they believe that this avenue can get to. Under the agreement that they signed mid last year with Tats, Jumbo granted them an option to acquire an additional stake in the business. That agreement, or the option, has gone through to Tabcorp, and we'd expect them to take up the 3.5 million Jumbo shares at a strike of about 272 by May this year. That will result in about $8 million of cash flowing into the business. Jumbo already has sufficient capital, already paid out a special dividend this year, and we certainly think they don't need this money, so we certainly believe that this will flow back out to investors, probably in FY19, but it does give them a very, very healthy cash balance with which to continue paying out high fully franked dividends and special dividends to investors. The stock on a cash adjusted PE based on the last price is trading at around 15 times. We don't view that as too onerous, given the strong double-digit growth expected over the next couple of years. And also with Tabcorp's result yesterday, they did show that there's been continued strong growth in the digital side of the lotteries business. The stock's trading around our price target. However, we do see further upside over the coming years, particularly as the Queensland development is completed, and we'll see a big shift in the Brisbane market from a gaming perspective. In Sydney, a lot of the renovation works have been completed in the non-gaming space. That did have minor impacts to gaming, but now that they're all completed, we expect to see non-gaming revenue up a fair bit, and also expect to see that flow on to gaming revenue. The company did provide guidance in October of 5.2% domestic gaming revenue growth, and we expect that to be a theme that continues through for the remainder of the half, particularly given some of the data points that we've seen coming out of Sydney. And also the Gold Coast with the strong refurbishments finished there. We'll see increased increased traction with existing customers and also increased foot traffic, which should flow on to higher revenues. So in Brisbane, there's not a lot happening there. They're just kind of treading water while they wait for the new development to progress. But in the interim, they're just spending a bit to maintain their existing customer base. So with the stock, what should people be doing? I mean, I still think it looks attractive here. As I said, it is near our price target, but the stock has rallied pretty hard into this result. So any weakness around it, we certainly see that as a buying opportunity. People Infrastructure, only listed late last year. It is another stock that we think you can buy heading into the reporting season. They don't have any half guidance out there in the market, but we do sit ahead of the prospectus on a full-year basis. The company have flagged and already made one acquisition since they listed. We certainly expect to see that as a trend going forward, and believe there's about $14 million of acquisition firepower for them based on a 1.5 times net debt to EBITDA level. We recently initiated with an ad rating on that stock and a $1.52 price target, and certainly think it's one for people to have a look at. One thing I would flag is that there are about 4.1 million shares that come out of escrow post this result, so just something to consider. Zenith, it's a tough one. The three businesses that they stuck together a little while ago have struggled from a merger perspective, which resulted in them last year downgrading expectations. It's the cheapest IP stock in the market, but with a new MD and I think still some integration issues to get sorted out. We're happy to sit on the sidelines at the moment. Our valuation is around the current share price, but given all the uncertainty at the time of the downgrade, we applied a 20% discount to that just to get our 110 price target. And lastly, Shine, they report on the 28th. Gross operating cash flow is always a focus for investors with this stock. And there is generally a big skew to the second half, given that's when insurers and everyone want to pay out prior to the 30 June end. We do expect to see a pretty solid result from the company, and believe that they can increase that gross operating cash flow conversion on the prior period. It is a key focus for management as well. Also, costs internally, they're focused on really trying to reduce these, and the engine room IT systems and other factors will help streamline business and also help reduce the variability of WIP and a couple of other factors that investors have been rather cautious of over the last couple of years. The company does have guidance out in the market for a full year with a modest increase on the prior year. So I think we've got about 3.5% increase at an EBITDA level. But again, cash is king with this stock, given the way that it reports. And we certainly think a good result here could see the stock start to trend back up towards our price target. So that's a quick run through of the stocks. Ones that are happy to buy, as I said, Jumbo and People Infrastructure, but they'll be shooting around some more information later today.